Hello, welcome again. So Amazon stock seems to be jumping about 10% right now on the announcement of a 20-to-1 share split. Their current stock price is sitting at about $2,700, so divide that by 20. This is going to be the new share price for Amazon. And for current holders, they're going to be getting 19 more shares per one unit of share that they are already holding in their accounts. That's how a stock split works, really. And investors are flocking in, buying more stock of Amazon right now because of the announcement of the 10 billion buyback as well. So the company is also going to be buying back some shares. And it's important to realize here that stock buybacks are generally speaking a good thing for investors. However, there is a very important thing that you need to bear in mind. As with any other investments that the company makes, buying back your own shares is also an investment. And if you're buying shares that are overvalued, even if they are your shares, then you are not using your free cash flow the best possible way. And that can have some impact. However, for new investors who are listening to this, they're like, okay, there's gonna be less of a supply for Amazon stock, so it's a good opportunity to buy, and that does make some sense for sure. And this is what happened with the announcement here. You will see that the split is going to be subject to shareholder approval, as it normally happens, at an annual meeting that's set for May 25 over here. And the board of directors for Amazon has already authorized the repurchase of up to $10 billion worth of stock. And you'll see that it doesn't have a fixed expiration. It's going to be happening opportunistically. So I guess whenever they find good market prices, that's good. That's a good thing. And the interesting thing to see here and notice is that if you are thinking of buying Amazon yourself, you still need to pay attention to the financials of the company. And some people, because the stock price is going to be cheaper, they are going to be buying Amazon stock again because it's a very well-known company. They are watching it go higher and higher. Now the stock price is cheaper. And so most people who are not really, who do not really understand how the stock market works and how market capitalization works, how a split works, they think that they're going to be having a cheaper unit and Amazon all of a sudden got cheaper. And that's not the case. Whenever there is a split happening or a reverse split is happening, nothing really changes in terms of the value of the company. That's the market value, of course. The market capitalization is going to remain exactly the same. It's just going. The only difference is just going to be that instead of having one shares, you're going to have 20 shares, but your unit, your single unit, will be divided by 20, the worth of it. And so you're basically getting 20 more shares that have a value of one of your previous shares when the company's stock price was sitting at $2,700. So that's what's happening. You're going to be getting something like 130 instead of $2,700 for a price for the price of a unit of stock. So regardless again of the buyback and regardless of the share split, we still want to examine the company's financials and determine whether we do want to hold Amazon stock. And we have of course done that in the past. But there is a very important thing that I wanted to point out here, because now we do know that already, really, that Amazon is a great company and it's making tons of cash, really, and it's doing very well. But we want to examine the free cash flow of the company, and I'm going to go to the cash flow statement here, and you will see that the company has been increasing its free cash flow, but then all of a sudden they have a loss over here. And the thing is, this kind of loss is a loss that Amazon knows about, and they do it on purpose. And the reason for that is that the expenses for that are actually capital expenditures. So Amazon is actually expanding with more warehouses and things of that sort that are business expenses. And so these are counted towards the reduction of free cash flow. And so you will see here that in 2017, Amazon was spending like 12 billion, which is probably the normal capital expenditure per year. And now they're spending about 61, which is way more, and has to do with capital expenditures again in the like similar to buildings and things of that sort. And so you could potentially think of the actual valuation of free cash flow here being a little bit more than what it is over here. And so you will see that the current one, it's sitting at minus 15 almost billion, in which I would probably add about 40 billion here. And that would be when Amazon actually normalizes and they don't really spend that much in capital expenditures anymore, because they have they have actually created so many warehouses so that they don't need more some years from now. And so if you exclude these capital expenditures, you're probably getting a number like let's just say 35. Just making it a little bit too confident here, but let's just say it's going to be $35 billion of free cash flow. And if you actually multiply that 35 number, supposedly 35, which is $35 billion a year, by let's just say a multiple of 20, you're going to get a $700 million for a market cap of the company, an expected market cap, as with a multiple of 20 times free cash flow is what we call that. And if we use a multiple of 30 times its free cash flow, and then again we use 35 billion, which is confident, because we could potentially use something like 20 to 25 really. But again, we're sitting at 1 trillion right now, $1 trillion. However, the market cap of the company right now is 1.5 trillion. So it's way more than that. And initially, remember, we had 700 million here. And so right now, the company is expensive, even if they were not expanding their operations here with more capital expenditures here. And so if you actually take a very, very strict approach and use a discounted free cash flow model, I just want to show you how that will look like, because the revenue growth of the company is pretty good as well still. And we can use something like 12, 13 and 14 here. But look at the net income margins are very, very low over here. And they're going to be, let's say, 2, 3 and 4. And the free cash flow margins a little bit all over the place, but typically they tend to be pretty high. So I'm going to go high here. I'm going to go 120, 130, 140, because that's the typical one. And again, this is skewed because of the insane capital expenditures. So I'm not going to take this into account, although the model will take it into account. And we're going to use an annual return of 13. But if you are looking at Amazon right now, as it currently is, with all the capital expenditures it incurs and the way it's running its business, you should be getting it at about half its price at most, really. Again, this is not very precise because of the expected capital expenditures and the way Amazon is handling things. And so, practically speaking, this value is going to be higher. It's probably going to be, I suppose, around $2,000 or something of that sort. But still, I feel that Amazon, although it's a fantastic company, and I would love holding the stock, I think I want to get it at a cheaper price. So, opportunistically as well, same thing that Amazon does themselves. Opportunistically, I'm gonna be waiting for a potential downtrend for Amazon, maybe at some point, and then I will accumulate some shares, because again, I love the company. I don't love the stock. The stock is expensive for my taste right now, especially right now, which is approaching 3,000, which is probably going to be the case. And so if the company is actually going to get, which I think it will, to $3,000, and you divide that by 20, the actual price of a unit of stock is going to be 150 when the split is actually done with. So that's what I wanted to talk about in terms of Amazon, so that some of you who are not really well aware of how this system works now understand that nothing really changes but the sentiment and the way people are actually feeling about Amazon, and some new buyers will come in just because of that, for sure. We'll have a short-term uptrend, another almost certainty, and you can actually make some money during that time, potentially trading as well. So that could be an interesting trade. But in terms of long-term investing, pay a little bit of attention here. You do want to get this company stock, but it's better to get it at a cheaper price because the valuation right now is extended. So be a little bit careful because of that, and don't just feel like you need to buy necessarily just because everybody will be buying right now because of the stock split. At least many people will. So stay in the sidelines and wait for the opportunity, wait for it to potentially go down a little bit. It will at some point, everything goes down. And if it doesn't, there are other opportunities as well. It's not really worth it to overpay, because if you are overpaying, then you are actually not making too much money back on a return. You're not making a great return on investment if you're overpaying. So, it's always worth to wait it out a little bit. Thank you for watching this one. If you enjoyed the video, please leave a like and subscribe if you are new here. And I'd love to see you on our Discord channel as well. You can find a link in the description box below. In the meantime, take a look at this video that I made earlier, and it talks about Pinterest. You may have thought about the company. You may want to take a little bit of a look and see what they're doing financially and whether it's worthwhile purchasing them. Thanks for watching, and I'll see you soon. Bye-bye.